candles on charts. We're going to start looking at technical analysis, so support and resistance levels on charts, and we're also going to look at things like breakouts, and then we're going to finish up that lesson, look at the difference between fundamental analysis and technical analysis. So obviously technical analysis is the charts and the price action and looking for opportunity within that. Fundamental analysis is a little bit different, so we'll go over that at the end of the lesson. But what's the main learning outcome for today in lesson 3? Well, the main outcome really is to understand how to read price action, what tools we're using to read price action, and how to start analyzing the charts in all time frames to see opportunity, and not necessarily just in Bitcoin, but maybe the other cryptocurrencies, and also really all of the other areas we can trade in. Because if we're trading, what we're looking for is opportunity across any market, and if we're trading based on price action and based on analyzing charts, really we're looking for the same opportunities in any instrument. So we can apply the skills that we're learning over the next few lessons to any instrument, not just cryptocurrency. And that's the difference between trading and investing. Investing, yes, it may just be cryptocurrency, but trading, we can really put it across anything, whether it be stocks, indices, commodities, or if we're talking about things like cryptocurrency. Let's get stuck in, guys, and let's talk about buying the market. So what exactly is buying the market? Well, when you're buying the market, you're looking to buy or go long. And that means if you think the market is more likely to rise in value, so it's on the way up. So essentially you are speculating on the rise in value of that instrument between now and a future point in time. Now, when we're trading on CFDs or contracts for difference, you never actually buy anything. So you don't own any of the cryptocurrency. You were just speculating on a specific price at one time, and it's going to rise to another price in any future point. So, if you buy a coffee, you're actually going to go into a shop and buy the coffee. Whereas what we're doing is buying the supply or demand of the coffee. So we're betting on whether that price goes up or down on the cup of coffee. So probably a little bit of a difference of owning the instrument and betting on the future value of the instrument. So let's take a really simple example to show what we're talking about. Okay, let's say we're looking at the Euro to USD chart on the Forex markets. Okay, so we're looking to buy into the Euro USD market. And what does that mean? It means that we believe that the Euro will strengthen versus the US dollar. Okay, so if we're buying into the Euro USD market, we're pretty much saying that our Euro is going to be worth more US dollar in a future point of time. So we buy €1. Okay, and that equals 135 US dollar, $1.35. Now what we're hoping is that goes up in value. So our euro in a future point of time is worth maybe 138, 139, 140 and so on. Now if the market does rise to 140, then we're in profit, because the market has risen. So we bought our euro when it was worth 135, and now it's at 140. Okay, so your €1 is now worth 140. We bought it at 135, and now it's at 140. Really simple. Okay, so if we buy at 135 and we sell at 140, then you're in profit of 5 cents. Okay, very, very simple. So what about selling the market? Well, selling the market is almost identical. The only difference with selling the market is that we're actually going to sell or go short because we think the market is more likely to fall in value. So it's going from the top down to the bottom. So you are now speculating on a fall in value of the instrument between now and a future point of time. And again, when we're trading CFDs and contracts for difference, you never actually sell anything. So we can profit off either one, whether the market's going up or the market's going down. It's just about looking for opportunity. So let's look at a really simple example of selling the market. Again, if we sell the euro to USD, we now believe that it's going to require less USD to buy euro in the future. So essentially, the euro is going to fall in value against the USD. So you sell €1 at 140. okay, then you're hoping that the market will fall to maybe 135. So now you would be in profit because you can buy back in at the 135, and because you sold at 140 and you bought back in at 135, again you're in profit of that 5 cents. So very, very simply, the only difference between buying the market and selling the market is when we're looking to bet on the market going up in value, we're buying the market. When we're looking to bet on the market falling in value, we're selling the market. And that is the only difference. They're essentially the exact same thing. They're the same opportunity. We can make the same amount of money if we have the same percentage gain. The only difference here is knowing what to do in that particular time frame on that chart in that opportunity. Now, speaking of that, whether we're going to buy or sell the market, we're going to make money if we do a correct decision. So how do we find the opportunities? Well, how we find the opportunity is through price action, through reading charts, and through understanding how to read charts. And one of the main functions and tools that we need to use to understand the charts is a Japanese candlestick. Okay? Now, Japanese candlesticks are very simply a price indicator used in financial trading to represent the price movement of any financial instrument over a specific period of time. That's it. Okay? All it is a price indicator. And when you start thinking about it like that, all it's going to tell you if someone's buying or selling the market over a specific period of time. Okay? So let's have a look at the Japanese candle in a close-up. Okay? So here on the right, you have two different Japanese candles. You have a bullish Japanese candle and you have a bearish Japanese candle. Now, they both tell us the same information. They're just telling us in which direction the market or that particular time frame is going in. Okay? So, a Japanese candlestick is a price movement over time. Very simple. Okay? So, a Japanese candlestick can represent 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hour, 1 day, 1 week, and so on. Okay? So we can represent any time frame really in the financial markets with a Japanese candle. And what we're looking for when we're looking for opportunities is to maybe look over multiple time frames to make sure that the opportunity we're looking at is correct over all of them. Okay? Now, when you have a lower shadow or a lower wick here, okay, that is the lowest price. This here, the lower shadow at the very bottom of the wick, that is the lowest price in that time frame. So whether it was 5 minutes, 1 hour, 1 day, that was the lowest price within that time frame. Then we also have an upper shadow. So the high wick here, okay, the upper shadow, the high wick is the highest price in that particular time frame. That's it. Very simple. And then we have the real body, the body of the Japanese candle. And very simple, if it's a green candle, the bottom point of the body is the open price, the top part of the body is the close price. And if it's a red or bearish candle, the open price was the top part of the body and the close price was the bottom part. So if this was a 5-minute chart, it opened at this price, this was the lowest point, it went to here, and it closed at this price here. Okay? If we're looking at a bearish, it opened at this price, it may have rose to this price here, it dropped all the way down to here, and it closed at this price here. Okay? Over the 5 minutes. Very, very simple. Okay? So it's just a price movement over time represented with 4 very important pieces of information. Okay? What does it look like on the chart? The Euro to USD chart is right there, and that's what it looks like. Whether you're looking at the 5-minute, 15-minute, 30-minute, 4-hour, 1-day chart, each candlestick will represent that amount of time. So if we're looking at the 1-day chart, we're going to have a much larger snapshot of what the market has been doing over a longer period than if we're looking at a 5-minute chart, because we're probably only looking at a few hours worth of price action. So if we look at both, we can make a decision about what way we want to trade and where the opportunity is. Okay, now let's look a bit more detail when it comes to the bullish and bearish candlestick and explain it a bit more again. Okay, so let's say we have a bullish candlestick. They are generally green. Sometimes they can be white, but most of the time we will see them as green. Okay, now as I said, the open price of the candlestick on the green is the start of the body. Okay, so the open price here was $100. Okay, the lowest wick is $80, so at some point it dropped to $80. The upper wick is $200, so over some point of, let's say this is a 30-minute candlestick, at some point in that 30 minutes it went to $200, and it closed at the end of the 30 minutes at $180. So it opened at 100, it went to 180 after the 30 minutes, so that is a bullish candlestick. It is bullish for the market. The market went up in value in that time frame. Okay, so we know now that the next candle open price will be $180. Okay, because what closed on the last one, it will open on the next one. What's a bearish candlestick? It's just the opposite. It's just representing the same four pieces of information, just in the opposite direction. So we opened at $200 maybe. The lowest possible price, it may have dropped to $100. It may have even went up past its open price at some point in the 30 minutes, maybe $220, but then eventually closed at around $120. Therefore, we know that the next candlestick is $120. It went from $200 open price down to $120 on the close. Therefore, it is a bearish candlestick. Okay, a bearish candlestick. Sorry guys, I'll go back on that. So that's your bearish candlestick. So let's look at that in the entire representation of time. Okay, let's look at a Japanese candlestick over a day. And if you were looking at it over the whole day, what it would be at a certain snapshot of time. So let's say it opened at 9 a.m. at $10. Okay, let's say we have some company, they've done an IPO recently, and at the moment each share is valued at $10. So it opens up today at 9 a.m. for $10. Okay, at 10 a.m. the market looks quite bullish. It's gone up to 10.20, and it looks very strong. Okay, 11 a.m. again, it's gone up to 10.50, so again, it's quite bullish because we've had a big jump in price. Now we've gone from $10 to 10.50, so if that had been a price move over a half a day, if we were trading the 15 or the 30-minute charts, might have made a lot of money out of it. Now, very hard to actually trade on those small time frames, and I wouldn't recommend it, but there are people that do it. Okay, now let's say around 12, the price starts to drop. Okay, it goes down to 10.30. And then by 2 p.m., what we have, it's back at its opening price. So it's back at $10. So now what we have is really no movement between 9 and 2 p.m. if we look at it right now. But we can see that over those few hours, we had, 4 different prices? So big difference. Okay? Then in the afternoon, drops down to 9.70. Goes to around 9.80 at 4 p.m. and then closes off at 9.80 at 5 p.m. So that's an entire day's worth of trading, let's say in the stock market, represented in the candlestick. Okay, so it closes off, and what we have is our 4 very important pieces of information. We have our opening price of $10. We have our upper wick of 10.50. We have our lower wick of 9.70. And then we have our closing price of 9.80. Okay, so we know the next candle is going to be 9.80. So here's my question for you guys. Is this a bullish or a bearish one-day Japanese candlestick? What do you think? Is it a bullish or bearish? Okay, well, we know that it's a bearish candlestick because it's red. Our opening price was $10 and we closed at 9.80, so we dropped in 20 cents of value. Now, depending on what we had bet on the price, whether it's contracts for difference, whether we own the stock, completely depends on how much money we make, but don't worry about that because we will cover that in the next lesson in whether we're going to trade certain instruments and what way we're going to trade them. But guys, I hope you understand that. I hope you're clear on that. That's essentially what a Japanese candlestick is. We have to remember that this is how most traders read price action. Okay, the Japanese candlestick is the gold standard of reading price action over a time frame, whether it be 5 minutes, 15 minutes, 30 minutes, and so on. It's a visual representation of the price at the time. Okay, the candlestick, all it's doing is showing you previous price action. So it doesn't guarantee future price action, but it will give us an idea of what the market sentiment was in the past day, week, month, year, and so on. Okay, and we know that history doesn't lie. Okay, so candlesticks don't lie. They don't attempt to predict future price. All they are is a factual based of that time period for the open, the close, the high, and the low. And it's giving us those 4 very important pieces of information. Okay, now of course it's not giving you the times. I'm just giving you the times there as an example. But your open, your close, your high, and your low, it's just representing over that time period. It won't tell you that the high was at 10 a.m. or that the low was at 2 p.m. It's just not something we can do. Some of the trading platforms will go into that detail, but we don't need to. Okay, so that is essentially the Japanese candlestick. Now there are a couple of Japanese candlestick patterns that we look out for that might give us an idea of a price reversal, but it does depend on where we see them on the chart. So we're going to look at 2 of the main patterns before we start looking at support, resistance, and trend lines, because knowing these patterns can help us identify a possible price reversal at a point in time where it might give us some opportunity. So the first one is a bullish engulfing. Now, a bullish engulfing pattern is characterized by a bullish candle whose body engulfs the previous bearish candle. So as you can see here, we had, let's say this is a 30-minute chart or a 1-hour chart. We had an open and then we had our close at a much lower price. But then what we have is we have our open and close completely engulfing the bearish candle. Now this can signify a reversal in price as an indication that the market is looking like it's starting to be bullish. But with any candlestick pattern, the bullish or the bearish pattern, it does take priority depending on where on the chart it is. So if it's nowhere near a support or resistance line, it may just be a temporary fluctuation in price. Whereas if it's getting close to maybe a support level, then it might be a good sign that it's going to bounce off support to the upside. So guys, if we look for this on the chart here, we can see 2 points where we have a bullish engulfing, okay? So we can see on this Brent crude oil chart that on the, say, the 10th of November, it was looking like the price was trying to drive in between 43 and 44, and the market just wouldn't allow it, okay? The market started to buy up when you see this huge green candle engulfing the previous bearish candle, and then we saw a little bit of a bull flag, so that means basically a huge buy, a small sell-off, and then it started to buy to the upside, okay? Again, we had a small sell-off, but again, a huge engulfing. We actually have 2 here. We have a bearish engulfing, but then immediately followed by a bullish engulfing, this huge green candlestick. Don't worry about this white patch, that's actually part of it. For some reason it's just been deleted out. But that is a huge green candle which continued to the upside for the next, what is it? Looks like sitting around between 56 and 54 now for the next 2 months. Okay, so from the 10th of November, we had a couple of bullish engulfings that drove the price up all the way between, say, 57 and 55 from between 43 and 44. So definitely an opportunity there if we had saw that around support lines that we had drawn on the chart. Now, when it comes to a bearish engulfing, it's essentially the exact same thing. The only difference is we have a bullish candle which is then engulfed by a bearish candle. And this is considered to be a good indicator of a possible price reversal to the downside. Now again, why indicator and possible? Because this is not a guarantee. The Japanese candlestick on its own will tell us exactly what those prices were in that time frame. So this is the day, this was your open, this was your low, this was your high, and this was your close. However, this pattern is not a guarantee. This is just an indication, especially if it's around a support or resistance level, that we might have a price reversal. So bearish around your resistance levels and bullish around your support levels. Okay? So if we look at this on the chart. Again, we have two huge bearish engulfings, okay? So we had the price, it looked like it was going sideways or slightly to the downside, but then after this bullish candle here, we had a couple of close engulfings and then a full-on huge candle. Completely engulfed the previous bullish candle, okay? Drove price all the way down even further. But then actually you can see a bit of a bullish engulfing here. Now if this was around a support level, you might have seen this as an opportunity to buy the market. It went all the way up over the next, from the end of December. This is we can see from the end of December all the way up to mid-February, huge price difference. And then we had a drop, a bearish engulfing here, and then to the downside. So again, if this was around a resistance level and this was around a support level, don't worry, I'm about to explain those terms, and we see these patterns around them, now we have opportunity to either buy or sell the market, and all we have to do then is set up our buy, our stop losses, our taking profit to make sure that we're 100% safe with our risk management. Okay, guys? So if you just get that amount, okay, if you literally get understanding a Japanese candlestick is a price indicator of the movement of that instrument over that specific time period. 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hour, 1 day, whatever it is. Now that is guaranteed 100% perfect information. It's previous price. And then if we understand bullish and bearish engulfing, okay, it can be an indicator of a price reversal. Then you probably know more than 60 to 70% of traders out there, retail traders, that seem to be overcomplicating their trading with all Fibonacci retracements and fancy trend lines and triangle patterns before they even understand Japanese candlesticks, bullish and bearish engulfing, and support and resistance levels. Now, speaking of support and resistance levels, let's get stuck into them, because that is the next most important thing we need to learn. We have our Japanese candlestick understanding, we have our basic engulfing patterns, and now we must understand our support and resistance levels. Because if you can understand this, you will now start seeing opportunity in any market to either buy or sell, and that's essentially what we're looking for in trading, to see opportunities where we might be able to profit. So what are support and resistance levels? Well, quite simply, they're floors and ceilings in a market. So these are price areas that tend to act as barriers, which may give us opportunity to read possible breakouts or reversals. Now, when it comes to market floors, okay, support levels, what are we looking for? Well, any past resistance is now a new support. So if we just broke out past a previous resistance price that we couldn't get through 3 or 4 or 5 times, we eventually broke up through it, and we had a good maybe 10-15% increase, but that's as much as we can do, and it starts dropping back down. Now we're looking for that previous resistance to become a new support level. Now, it's not a line, it's not an exact price. Support is a zone, it's not a line, okay? Now, if it does show that it will support the price around that zone, it will act as a barrier, and now we can draw that out in a chart and know that, okay, well, every time we've reached this point in the last 2, 3, 4, 5 times, it's bounced to the upside. It hasn't broken through it. Okay, so it's possibly a temporary support or temporary floor to the market where the market just doesn't want to go any lower. Now that's where there is opportunity for us, because if it looks like it won't go any lower every time it reaches here, it may be an opportunity to buy the market. Because we know previously it has bounced 1, 2, 3, 4 times, so now we have the opportunity where we might be able to buy the market. Okay, now, as I said, it may indicate a current market floor, but it is not a guarantee. Okay? Just because we've bounced off it 3 or 4 or 5 or 6 or 10 times doesn't mean we're going to bounce off it this time. So again, just like a Japanese candlestick, it is only giving us price action previously. It's not giving us future action. So it's not a fortune teller, it's just an opportunity, and that's why we set up things like stop losses and risk management, which we're going to cover over the next couple of lessons. Because even if we're only right 45% of the time, if we do correct risk management, then we will actually be able to profit even when we're wrong. So guys, let's look at an example of this, okay? Let's say we've started trading. We only started trading there a few weeks ago, but our friend Jimmy's been trading for a few months or a couple of years, and he's claimed he's made a few grand, and he's pretty good, pretty handy at reading support levels and reading charts. And he says to you, look, here gold, right? So he's looking at gold back in June, and he says to you, look, gold has bounced 1, 2, 3, 4, 5 times, okay, 5 times off this support zone, okay, up around 1300, 1298, okay. So he's saying that, listen, it's going to bounce off it again. So I'm setting to buy the market. I think it's going to bounce and it's going to buy again, right? So he's predicting it that it's going to bounce. All right, what do you think we should do here? Okay, and where is the opportunity here? Is the opportunity that it might bounce? Or is the opportunity that it might actually break that support zone and go to the downside? Because if we look at this support zone has been tested once, twice, 3 times, 4 times, 5 times over, it looks like a 2-month, 3-month period. Okay, so there is technically 2 opportunities. It could bounce and go to the upside, or it could break through and go to the downside. Now, before we actually make a decision on what way we're going to trade this, what do we want to do? Well, we want confirmation of what the price is doing. Because if we just bet that it's going to bounce, so because it bounced 5 times before, so it's going to bounce again, so let's just enter the trade the next time it hits 1298, and let's buy the market and hope to make 10, 15, 20, 30%. All right? However, there is also opportunity that below 1298, okay, below that low point of that zone, there's an opportunity to sell the market, okay? And if we're too short-sighted and just assume it's going to bounce, if I fast forward, we can see that there was a huge break at 1314 and a huge drop to the downside, okay? So if we had have assumed it was just going to bounce and set up a trade for the bounce, as if it was going to, again, do what it did in the past and go to the upside, we would have lost a hell of a lot of money, especially if we didn't have stop losses in place. So what we want to do when it comes to trading is we want to see a pattern, we want to see an opportunity, and then we want to see confirmation of a bounce or a break. Because if we see confirmation, then we might be quite happy to enter that trade. So let's say we were looking here, and you could technically set up 2 trades, but if we were waiting for it to bounce, we could have set up a buy-in at maybe 1320. So wait until it went below, close to the 1314 or even the 1298, and if it bounced, we could set up a buy at 1316, 1317 if it does bounce. And then we might at least see a bit of confirmation on the bounce. Or even better, if we had said, look, we've had 1, 2, 3, 4, 5 tests of this support zone. So what are the chances that we might get a break? And we did. We had the breach at 1314. So what if we had set up to sell the market below 1298? Okay, below 1298 here. So our support zone is here. So 1298 even. If we had set a sell the market zone here, okay, so a limit sell where it wait to reach that, we see confirmation, and then it confirms our sell in the market, and then we've made a lot of money. Okay, we've made a lot of money, and we can take profit on the way down, or we can set profit taking zones. Okay, so we always want to know the opportunities. Then we also want to know where we're getting in the market and where we're getting out of the market and where we're setting our stop losses and where we're setting our profit. Because if we're too short-sighted and we just enter a trade at the market price thinking that it's going to bounce, then that's where we're going to lose all our money. Okay, that is where we're going to lose all our money in trading. People who try and predict charts, Charts are previous price action. You cannot predict charts. They can do anything. They can bounce 10 times and then crash to the downside. And they will never tell you why. Even fundamental news might necessarily tell you why. Okay? So again, a floor, a support is a zone, it's not a limit, and we're looking for confirmation of a bounce or a break. We don't want to enter a trade around that zone. We're looking for confirmation one way or the other. Because if we follow Jimmy's advice and saying, look, buy the market at 1298.50 or 1298.90 because it's going to bounce like all the other times, well then we're going to lose all our money, right? Now, the other important thing we need to remember about support or support zones is that we're not just seeing support zones, because previous support is future resistance. And we actually see this on this chart, because if you look at it, we had that break at 1314, then we had a massive sell-off. It continued down a little slower, but then we had a reversal. Okay, we had a bit of an engulfing pattern, and it came all the way back up to up around between 1298 and 1314. Okay, so again, now we're heading towards a previous support zone, which is now a resistance zone. Support, future resistance, resistance, future support. So they're not one or the other, they are actually the same, just at different timelines. And we can see this. If you start looking for this on the chart, a previous support zone is a future resistance. So we had a break here, continued, actually broke down. We had a tiny bit of support here, and continued to the breakdown, and then we landed here at a support zone up now. The previous support is now resistance. And now we're going to retest this, and possibly retest this until we break through or go back down and drop to the downside. Okay? So support, resistance. Support and resistance. It just depends on the time zone. Okay? So we're always going to see these in one and the same. It just depends on the time period, what the chart is doing, and how we've read them. Okay? So again, it's getting used to seeing these patterns. And I'm going to show you in a few minutes on MetaTrader 4 how we can start drawing these patterns out. How we can start looking for these patterns, looking for these price zones, and we can start to make decisions about what we might want to trade over what time period. Okay, so let's talk a little more about our support and resistance levels, and let's talk about resistance levels, because we talked about support levels. So what are they? They're market ceilings. Okay, so past support is our new resistance. Okay, it's a zone, not a line. So don't pick one price. It's most likely a small zone of price which we will continually bounce off to the downside until we break through. Okay, it will act as a barrier to the upside. It will keep stopping us going further up in the market because it's acting as resistance. It's a temporary resistance. Temporary means it can break any time. It may indicate current market ceiling, but it's only showing previous price action. Again, guys, it is not a fortune teller. This can break at any time for any reason, and as much as people would like to tell you that there's a simple explanation for it, ask to see their wallet, ask to see their trading wallet, ask to see their past successes, because most likely if they're calling the market at specific points, they've lost huge amounts of their capital. And there's a 90-90-90 rule in trading where 90% of people lose 90% of their capital in the first 90 days. So if you manage to hold on to most of your capital for the first 90 days while you're learning, trust me, you're doing better than 90% of speculators and retail traders. Now again, if we have a look at an example of resistance, let's look at the DAX chart here over like a 5-month period, okay? And we can see a fairly consistent ceiling or resistance zone. It's up around 107.5 up to 108.5, or 107.3 up to about, 107.5 to 108.5. Okay, so we have a zone there where it's literally bouncing off it 1, 2, 3, 4, 5, 6 times. All right, so we're continuously hitting this ceiling. Okay. Now what we can also see is there is definitely a bit of an upward trend even though we have a ceiling. It's a little bit of an upward triangle because what we actually had was we had a low, we had a higher low, we went to the upside, we hit the ceiling, we dropped down, we had a higher low, and then again it went up to the ceiling. Now we did have a further drop, but again it bounced up, hit the ceiling, and then we dropped down. Now most of these are higher lows. We did have a little bit of an accumulation phase here where it was sticking around a straight resistance, so we could technically draw an actual support zone here. So we would have a tight support and resistance zone, but we also have an upward trend which it seems to be bouncing off. So if we assume that that upward trend line is pretty solid, then what we'd expect is it to bounce off this upward trend line in the future and head towards that ceiling. And if I fast forward maybe a month into the chart, we can see that we came down, bounced off the trend line, had a break to the upside, broke through, absolutely smashed through that resistance zone, and then continued to the upside for a fairly large profit if we had had a trade in place. So again, it's what are we actually looking out for? We're looking for a support zone. We're looking for a resistance zone. We're looking for a range of prices where we can recognize an opportunity, and then we're looking for confirmation of that opportunity. Now, where is the confirmation of this opportunity? It's this bullish engulfing that bounced off our trend line. Now, again, this was possible that it might have stayed within that zone, so we can wait for confirmation to break through and set up a buying the market at around 108.20 maybe, and we can still make a healthy profit. But if we take the risk and try and predict below that ceiling, we may lose out. So if we're waiting for the confirmation, if it is a good break, then we're still pretty safe when it comes to setting up stop losses, when it comes to risk management. But if we continuously try and predict the market, then that's where we're going to lose money. So we need to start recognizing support zones, upward trend lines, resistance zones, breakouts, and really confirmation of all these things to spot opportunities. So guys, let's start looking for these patterns. So let's say I just pull out a chart here. This Great British Pound to the New Zealand dollar, okay? And just look at this chart for a minute. And if you look at this chart, take it in sections, maybe 1, 2, 3 sections, okay? Take the first third, the middle, and then the last third. And look for patterns. Can you see an uptrend? Can you see resistant levels? Could you draw out support zones? Could you draw it out a trend line that may be a support zone, which then had a break? And the best way to start learning support and resistance zones is to start looking at the previous month's chart and drawing out where you see the patterns. Because if you can start spotting the patterns, the higher highs, the higher lows, the lower highs, the lower lows, on bullish and bearish sentiment, now you can start seeing the opportunity. So if we take the first third there, we can definitely see an upward trend support line, okay, which was eventually broken. And we can also see there's definitely a support zone up towards the top. Now what happened with this? Because it was a fairly large range at first, and as we got to the top, it started to squeeze its way in, okay? So if we can see a ceiling and an upward trend or a downward trend and draw it out, what we might see is a squeeze in price, and that's where we might see the opportunity. Now here it didn't complete the pattern. It eventually broke the trend line and dropped to the downside. And then where's the next support or the resistance? The resistance is the previous support. Yeah, we can draw the next one. So where's the next obvious one in the middle of the chart? Well, we can see the price bouncing a few times off here. Now we had a bit of a break here, but it looks like a false break. And we had a downward ceiling. Okay, so we had a fairly flat support level, and we had a downward resistance level. So again, we had the opposite triangle. So even though flat support and resistance levels are much more accurate, we can see them at angles, and they will give you possibly a squeeze triangle to the up or down or really just an opportunity where you can see where the price is being squeezed, a price wedge, if you will. Because this is what they are. They're price wedges between ceilings and supports. Okay? And again, on both of these examples, a break to the downside. We went up and started our ceiling at the previous support and then dropped down. We were following a bit of a trend. We hit a support. Now, we mightn't have seen this until here. Okay, and that's where we drew it out. We mightn't have seen this until here, so we eventually see the squeeze here, and again has a false breakout, comes back up, and then breaks through. So this is why it's a zone and not a line. Okay, a false break to the downside, back up, and then a real break to the downside. And then lastly, guys, again, we can see a possible opposite direction when it comes to the trend line on the support and the ceiling. So what's going to happen next? Well, again, we don't know. We just have to look for opportunity. We just have to look for opportunity future on in that chart. How close, how tight is the price range going to be between the support and the resistance level, whether it be a wedge or whether it be two straight support and resistance levels? Okay? So, it's just a matter of recognizing these and starting to being able to draw the patterns so you can possibly see opportunity in the future. Okay? No one is a price predictor. We're just looking for opportunity, and if we learn how to do this properly and set up trades properly, and again, we will over the next few lessons, guys, you don't have to be right 100% of the time. You don't even have to be right 50% of the time. If you've good risk management and you're right 45% of the time, you can still be in profit all year long, once you are setting up the correct trades with the correct risk management based on your technical analysis, mixed with maybe a little bit of fundamental analysis. Okay? So we're looking for breakouts. Now breakouts can be to the up or the downside. So they're going to break resistance or they're going to break support. Okay? Break to the up, break to the down, it doesn't matter. It's as equal opportunity. What do we think is more likely and what are we waiting for in confirmation terms? Okay, we can think or we can lean towards one or the other, but we might see a false break, a bounce through. We might see a false break in the support level, then come back up through the support level and break through the resistance. So even if we think we're right, not necessarily. We're always waiting for confirmation. There's always opportunity in both scenarios. And this is why you don't have to be right. So many traders feel like they have to be right. So many traders feel like 100% of the time, 90% of the time, they have to have their calls. Like you'll see these pump and dump groups on social media now or on social trading platforms where you'll have traders claiming that they have a 80-90% call rate. And that's just not the case. That is just not the case. You know, it may take a few test levels at a support or resistance to actually see a break, and you really have to practice drawing your support and resistance levels, whether they be straight or at a slight angle, to start seeing these break opportunities, whether they're to the up or the downside. And again, guys, I'll bring you into another chart. If you look at this chart, and I have nothing drawn on it yet, can you see any patterns? I mean, we can see a fairly clear support zone in the first third. We can see a fairly clear ceiling. We can definitely see a break. Then we can see an upward trend, a support level, and a continued upward trend. That's what I see when I look at that. So if I'm to draw that out, first level, there we go. Second level, here we go. Okay? So these are zones. Okay? Then we have a big break to the upside, and then eventually hit a resistance level, support level, break to the upside, support level, resistance level. So what's next? Again, we're waiting for confirmation. Where are we actually going to take these trades? This is fairly tight. I mean, you can draw it. I'm not sure. Would we have seen this at the time? However, this is fairly clear. So we have support level, we have a resistance level, and they're straight levels. Now, straight levels are always usually a bit clearer than trend line levels. The trend line is to down or to the up. Okay? But straight levels, straight support, straight resistance can be a bit clearer. So we know that this has tested support and resistance a few times, back and forth, over this 3-week period. So we know this zone is pretty safe. Okay, and the previous support is now resistance. So if we're looking for confirmation here and we set up a buy zone and a stop loss just below it, we would have made a good bit, and then we just set our profit taking as we go up. Okay, and then we'll eventually hit a ceiling, drop down, and then it's a case of can we spot the support. Okay, it's not necessarily, this isn't obvious until we hit it a second time for me. Okay, because this was on the way up, on the way up, on the way up. Yes, we have our ceiling. Now it's coming down. Is that obviously a resistance? It could be, but we don't know. It's not clear from the previous candle, so it's not clear here. So we want to see it test again. Now it's definitely a clear resistance line. So now again we have a straight resistance, a straight support, and now we're looking for confirmation of a break either way. If we break to the downside, great. If we break to the upside, great. But if we can spot the opportunity and wait for confirmation, we're doing good, right? We're doing good. And then here, maybe not as clear, okay? But again, we have resistance. For me, this isn't clear yet until we hit it again over here somewhere, okay? It's not clear for me with this unless we hit this again. We can bounce off the ceiling a few times, but unless we actually hit off this again, could easily break to the downside. Okay, and could be easy on a downtrend. I'm waiting for confirmation either one way or the other. Yeah, so start drawing these out, start practicing, start looking for these in patterns, and when you can start seeing the patterns now, you can start seeing the opportunities. All right, and we are going to, on the next lesson. Look, we're going to open up our trading platform. We're going to start drawing these out. We're going to learn how to see opportunity. We're going to have a demo account that we can test trades on. So if we're wrong, doesn't matter. We're losing fake money, so it's fine. But at least we can really start testing ourselves in what we're viewing on the charts and where opportunity is. Because what we're looking for is opportunity over 5, 6, 7, 8, 9, 10 trades. That's what the professionals do. We're not looking for one opportunity. You know, if we're trading cryptocurrency, we're not looking to trade on Bitcoin. We're looking to trade on Bitcoin, Ethereum, Litecoin, Cardano, you know, EOS, Neo, Ripple, all of these, looking for opportunities in all of the charts. And again, if we're trading, we're not even just looking for it in crypto. You know, if we learn trading, remember, crypto, great long-term investment if you like the technology, but if we're going to trade and you learn all this, why not take gold, silver, commodities, forex markets? You know, if you know this stuff, you can apply this to any market. And that's the great thing. So you start spotting these patterns. It doesn't matter what it is. It doesn't matter what's Euro to USD, whether it's Bitcoin to USD, whether it's gold to USD, whether it's corn to USD. It doesn't matter, guys. What matters is you can spot the opportunity and make money from that. So, guys, I hope you learned the basics of support, resistance, and the different ways we can do it in that section. We're going to wrap up the lesson, of course, talking about technical analysis versus fundamental analysis. And you'll see that I use the same pictures that I used for trading and investing. Okay? Because I think if we're trading, we're definitely going to use more technical analysis. And if we're investing, we're definitely going to use a little more fundamental analysis. Why? Because on fundamental analysis, we're evaluating an instrument on its intrinsic value. We're looking at the impact of the financial environment. We're looking at the impact of the business environment and its future potential and proof of work. So any of these things can definitely affect price long term, but short term, unless it's absolutely massive, it may not. Okay, so short term, the impact of the financial environment is not going to have a huge effect on a lot of what we're looking at unless we're having an economic crash or an economic boom. Okay, future potential and proof of work is very much about long-term investing. That is not going to help us in our day-to-day trading or in our short-term trading. So it really is fundamental analysis about doing your due diligence about an instrument and whether it's, I suppose, volatile enough and steady enough at the same time to trade on. When it comes to technical analysis, what are we looking at? We're looking at how to assist our trade selection. Okay? It's a standalone form of analysis when it comes to trading. It is based on the market, but it's also based on human behavior. Why do we have support zones and resistance zones? It's because the market has decided that they're barriers. Now, the market is just a bunch of people. It's you, me, financial institutions, and large corporations. Okay? Now, technical analysis is easier for new traders to see a clear approach in trading. Fundamental analysis is a bit different, and you really have to understand, I suppose, the industry a lot more than if you're just using charting to do so. Okay, so it's definitely easier for new traders. It's based on previous behavior of that instrument, of that price, which is great because now we can look for opportunities from the previous actions, I suppose, in the market. And then the results, it's good for great objectivity and to control your emotions. Because if you get emotional about a price, if you get emotional about thinking it's going to bounce from a support zone or breakthrough resistance level, well then you're going to get too caught up in it. But if you stick to the fundamentals of technical analysis, whereas look, it might break through the support, it might bounce off the support, all I'm waiting for is confirmation. And then I'm waiting for whether I'm going to enter a trade and wait for it to take profit on the way up until it hits a ceiling, or am I going to wait for it to break one or the other? So it's up to yourself. Can you see, possible swing trade opportunities, or are you long-term looking for the opportunities where there's large breakouts to the up or to the downside? So that's the difference between technical analysis and fundamental analysis. For me, technical analysis is majorly about, trading. It very much is about trading with a small amount of fundamental analysis, and it's the opposite for investing. If you're investing, you want to be fairly deep in the fundamental analysis of understanding the industry, what's going to affect the industry, what's going to affect the value long-term of that instrument, and how confident are you after doing your due diligence of the value increasing over time. So not necessarily something that's going to help us massively in our trading, but very much in our investing. So guys, I hope you enjoyed that lesson. Let's have a quick recap of lesson 3 because there was a huge amount in that. So we looked at price action and Japanese candles, and that is the first thing you have to get your head around. Understanding price action, how a Japanese candle works, what time frames we're looking at, how it opens, closes, highs and lows, and the engulfing patterns that may be signs of price reversals. Then the very basics of technical analysis are support and our resistance levels and looking for breakouts